Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. Every year, Northern Trust Asset Management issues a multi asset class 5-year investment outlook known as its Capital Market Assumptions Report. Per the recently released 2023 edition, Northern Trust is expecting market returns to be slightly below long term historical averages. And while they believe lower stock valuations may provide some support, upside will be limited by higher interest rates. They see a somewhat similar dynamic playing out with bonds, where returns will be supported by higher yields that will be capped by flatter global yield curves. Among the 6 investment themes they've identified as driving markets over the next 5 years are slow growth transitions, which looks at such slow transitions across the globe as pandemic to endemic, globalization to regionalization, and fossil fuels to renewables. Here today to discuss CMA's themes and forecasts is Chris Shipley. Chris is Chief Investment Strategist for North America at Northern Trust Asset Management, which offers the extensive lineup of Northern mutual funds and flex shares ETFs. He is responsible for the strategic and tactical asset allocation policy for its institutional and wealth management clients, and Chris is a voting member of the firm's Tactical Asset Allocation Committee and Investment Policy Committee. He's also the co-portfolio manager of the Northern Global Tactical Asset Allocation Fund. So, Chris, tell me a little bit more about your background and a little bit more about what your role consists of on a day-to-day basis.
All right, sure. And thanks for that introduction. Of course, thanks for having me on. As you mentioned, I'm the chief investment strategist for North America at Northern Trust Asset Management. I've been with the firm for 22 years and have followed a path through the fundamental equity business, beginning as a bank analyst, a position that I held through the financial crisis of 2008 and 2009, which was a very character building experience, shall we say, and then later director of equity research and head of fundamental equities. So I've always brought a bit of a bottoms up lens to the top down process that I'm now a part of, which is a nice complement to our other macro work that we do at the firm. So, but again, thanks for having me on.
Well, you're welcome. It's a pleasure. So let's begin by talking about the 6 investment themes that are in this year's Capital Market Assumption Report. Those are what Northern Trust says distinguishes its investment outlook. In my introduction, I briefly mentioned slow growth transitions. Let's start with that. Give me a more complete understanding of what you mean by slow growth transitions.
Sure. So many of our themes are interrelated, but when it comes to growth, we do see several headwinds over the next 5 to 10 years that will lead to somewhat less than inspirational levels of real growth. And driving that slower growth, we have several carryover implications from the past handful of years, including demographics with baby boomers retiring, as well as the elevated levels of debt in the public sector in particular. But we also have some newer headwinds to growth, including a normalization post the stimulus fueled growth during the pandemic, which took us above trend, not only economically, but in terms of corporate profits as well. The trend toward deglobalization, with an emphasis on reducing dependencies on strategic adversaries, whether it be Russia for Europe or China for the United States. We also have the acceleration of movement to renewables in Europe. And while that transition may be slower in the US, it is still a relevant consideration for longer term growth. In both cases, whether it be moving supply chains or investments in renewables, it essentially represents a replacement of something that we already have, which tends to crowd out other investment and will prove inflationary over time.
Let's talk about some of the other themes. There are 5 other themes: inflation, recalibration, monetary drought, regional rebuilding blocks, green transition still a go, and not so negative. Those are the titles that you gave in your capital market assumption report. Walk me through those other themes and the significance of them.
Sure. So we'll start with inflation. What we're calling inflation recalibration. It's really the end of an era with respect to this very low inflation that we've had. We do forecast higher levels of inflation going forward, certainly versus what we've been accustomed to. where inflation had been trending lower for some 30 plus years. And this was, of course, led by forces such as technology and automation, which brought a lot of efficiency gains to the economy. And when combined with the deflationary aspect of globalization, central bankers really found themselves fighting to bring up inflation, not bring it down. Now, while technology and automation are still very much at play, even if somewhat less transformative going forward, we do have other issues that we have to contend with, including deglobalization, which I know we'll talk more about. But just as globalization was deflationary, unwinding that will have the opposite effect. Relatedly, we'll be dealing with stressed supply chains for at least a portion of our 5 year forecast and possibly a good bit of it. Commodities are likely to stay expensive on tight supply once the economy finally finds its footing. And then labor supply is somewhat challenging, just given that you had this significant increase in wage growth that we've experienced of late. That's clearly, again, well underway, and we don't expect it will necessarily persist at this level, but we do think that wages will be a source of higher inflation than what we saw, say, in the pre pandemic period. Relatedly, when we think about inflation, we have to think about the monetary response. So, in what we're calling monetary drought, is really what we're calling the response to that inflation. And with inflation largely having run under central bank targets for so long, one of the features of the past several years had been the exceedingly accommodative central bank policy, a monetary flood, if you will. Given our outlook for inflation, we think a monetary drought is upon us. And as we look ahead, the near singular focus of bringing down inflation and anchoring inflation expectations will mean materially higher policy rates than the economy or the market has become accustomed to. And importantly for the Fed, inflation expectations have come down materially when looking at inflation break evens, suggesting that the market believes that the Fed has the tools and the resolve to bring inflation down. That's an important step in the process, but it's clearly not sufficient. Central banks actually need to follow through, and we think that they will. So that means that the economy needs to adjust to higher nominal interest rates. We're feeling that in a big way when it comes to mortgage rates. As you know, rates on mortgages have more than doubled year over year from 3% to now north of 6%. You add in home price appreciation, and someone who's got a 20% down payment on a mortgage has seen the monthly payment on that nearly double versus where it would have been a year ago for the same house. And that's dramatically cooling housing market activity, which is one of the bigger economic multipliers in the economy and therefore depressive to growth. In addition, investors have to get used to higher interest rates, which have several implications. Higher rates on cash make it a viable asset class, finally, which is far different than the drag that has played for several years. Higher long rates also have a depressive effect on PE multiples for equities, particularly for growth stocks, which has hurt tech stocks this year, and it's hurt US stocks versus Europe, at least when looked at in local currency terms. And then higher rates also mean that equities aren't the only game in town, particularly if we're right about forward returns for stocks being somewhat more modest. The fourth theme that we've talked about is the regional rebuilding blocks. And this theme largely relates again to this issue of deglobalization, specifically tied to economic, technological, energy, military security. And at its core, these themes really relate to this trajectory of reducing dependencies on strategic adversaries that I mentioned earlier. Europe is learning that lesson clearly with respect to energy security in Russia. And the less than positive relationship between the US and China poses similar but even more complicated risks. China is exceedingly important as a source of imports into both the US and Europe. Clearly, the world can't separate itself from China in the same way that it did from Russia. It's just far too meaningful. And too much of global supply chains have ties to China to make this process simple. So, for companies, we do expect a beginning of the long and frankly expensive process of moving supply chains and limiting incremental long term capital commitments inside of China. And then for investors, which can be more nimble, you're seeing more consideration given to investing in EM ex China, for example. And ultimately, the rebuilding of supply chains will take a very long time, but we do believe this is a trend that is relevant to investors and to corporate profits over time and does represent, again, upward pressure on inflation and downward pressure on corporate margins over time. The fifth theme is what we're calling green transition still a go. And candidly, we struggled a bit with the name for this theme as there are several cross currents when it comes to climate and the move to renewables. In essence, you have two time frames to consider. In the short term, you have that which is dominated by the energy security issues around the world, which is most acute in Europe, which to date, Europe has really been a leader in the context of this transition. But for now, they are in need of energy by any means possible, which is really setting back the agenda there in the short term, but likely accelerates it in the medium term. The energy security issues in Europe have made the transition in the US even more politically charged, with the energy independence aspect of fossil fuels prominently being argued. But while the energy insecurity has certainly proven to be a near term obstacle, we do see that the green transition is still a go, particularly when considering that green energy will represent a path toward energy security for Europe and what is likely to be an elevated level of commodity prices over the medium term, just given the lack of upstream investment, which will facilitate cost parity, which is critical from an economic justification standpoint for many parts of the world. The sixth and final theme, not so negative, one of the most, I guess, interesting and potentially impactful changes in the financial markets of late is higher interest rates. And as you'll no doubt recall, back in 2020, we had over a quarter of global investment grade debt with negative yields. Well, that's all but gone, apart from Japan. And in a far cry from that, the futures markets are now suggesting the Fed will be north of 4.5% by March, which is dramatically changing the role of cash or fixed income more broadly in the context of portfolios. Now you can achieve a notably positive yield, making the investment more attractive relative to potential risk asset returns, with higher rates themselves, again, having a depressive effect on valuation and equity. So it's been a long time since we've had fixed income returns forecasted at these levels, and it has some pretty important consequences in the context of portfolio construction as well as the relative return opportunities between asset classes.
If I were to sum that up, I would say that you're looking at higher inflation, higher policy rates, higher rates in the bond market that will spill over into the mortgage market, that will slow down the housing market, will depress equity valuations. We're going to see deglobalization that may favor some non US markets like the emerging markets. And then we've got this green transition to deal with. I want to talk about how that now translates to the investment themes that you think will drive the market. Let's look at bond markets. And I know the capital market assumption report foresees global high yield leading the way at around 7.5%. I believe it's your largest tactical overweight in your global policy model. In such a challenging and volatile market, why overweight junk bonds?
We see high yield as an attractive asset class from a risk reward standpoint, as it does have asymmetric characteristics relative to equities. In other words, the beta or participation to the downside is lower than the beta to the upside, which generates that positive skew. So you have downside protection, but a lot of upside participation relative to, say, equities. And it should be noted that this really isn't your father's high yield market. Significantly more of the high yield benchmark is toward the double B end of the credit spectrum, making the term junk bonds a bit dated and somewhat misleading, particularly when viewed as a risk asset, which is how we view the asset class. While certainly riskier than, say, investment grade bonds, they are notably less risky than owning stocks. And that's particularly true when you consider the health of corporate balance sheets today and the strong likelihood that that should we see the economy dip into negative territory, that such a contraction should be shallow and not lead to a dramatic rise in loss events for high yield. So we do like the asset class strategically, given that risk reward profile, and we like it tactically, just given the dislocation that we've seen this year in the wake of rising economic concerns. What's been unique, of course, about this year and why bonds, including high yield, have not offered the degree of downside protection or diversification benefit that we're accustomed to is inflation. Normally, when economic concerns are increasing and spreads are widening, which is bad for bonds, interest rates are falling, which is good for bondholders, which provides some offset. This time, because of inflation, the fact that the rise in rates to battle that inflation is the source of the concerns for the economy, you're not getting that natural hedge that you would normally see. But if we're right that any recession would be shallow, when considering the rise in credit quality of the index and the health of corporate balance sheets, we're pretty optimistic on the return prospects for high yield going forward.
Another theme in your report is has to do with the global equity market. The U.S. has materially outperformed the rest of the world for at least the past 5 years. I think even going back further than that. How do you think about that outperformance when you consider what the prospects are for the next 5 years?
Yeah, it is true that the US has shown pretty significant outperformance versus the rest of the world on a 5 and yeah, even 10-year basis. And a portion of that has come from valuation, where PE ratios have been more durable in the US, though most of the differential, frankly, is coming from fundamentals and specifically better earnings growth. So, better revenue growth has played a role in that, which is tied in large part to nominal GDP growth, but also strong margin performance, aided in part by the 2018 corporate tax reform, but was certainly broader than just that. And as you know, the US market is really dominated by large tech and tech adjacent companies and industries, which is making it the growth market for all of global equities, which has been a very good place to be in a period of very low interest rates and transformative technological change. If we look ahead, the higher rate backdrop is more problematic for growth stocks, as more of the value of growth companies is out in the future, which makes them more sensitive to the discount rate that you apply to those future earnings. And then fundamentally, while economic growth a bit more sluggish around the world is somewhat problematic from a big picture standpoint, again, the investments needed to be made in supply chains, et cetera, we think that that will create some margin headwinds for companies, including those in the US. And so that all suggests that some of the advantages that the US has enjoyed for the past several years may be somewhat less evident prospectively, but it's always hard to bet against the US just given some of the structural advantages. And it is our preferred region tactically on that 1 year horizon, just given the more notable challenges that we see elsewhere in the world.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from advisor perspectives every day. So why not use our award winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Fowl for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. If someone were to bet against the U.S., which of the non-U.S. markets do you like? You like emerging markets, developed markets, or somewhere in between?
And so some of the factors that I mentioned that represent headwinds to the US, such as higher interest rates, are somewhat less burdensome from a valuation perspective, at least for areas like Europe, where a much larger portion of their index is in industries and companies that are considered to be on the value end of the spectrum. So therefore less sensitive to rates in that negative way. But they are also more cyclical. So they're tied to nominal growth, which actually is a bit better because of the higher levels of inflation that we see right now. So inflation from a market perspective is probably a bigger headwind to the long-term performance of the US than it is to some other markets. Now, Europe undoubtedly has its near-term challenges with respect to commodities, and we are more cautious there on a 1 year tactical perspective, but valuations there have come down a lot. The longer your forecast horizon, the more important valuation becomes as a determinant of returns, of course, because stocks aren't all that sensitive to valuations on a short term basis. The directional trends across a variety of other factors can overwhelm them. But longer term, valuations have a lot of predictive value, and there, Europe certainly has an advantage. Now, EM is challenging. So, emerging markets, you've got China's 35% of that benchmark, making the outcomes in China very important to the outlook for emerging markets broadly. Deglobalization, as we've talked about, is certainly a threat to China, as it is the world's largest beneficiary of globalization over the last 20 years. And as productive capacity is slowly repositioned elsewhere and critical technologies are withheld strategically, China faces some intermediate term challenges that are on top of the current difficulties that they have around their zero COVID policy, as well as the managed deflation of their real estate situation. And that's all while considering the long term demographic issues. Now, some of China's challenges are actually opportunities for others in EM. So, transitioning manufacturing and supply chains to other parts of EM that are less strategically threatening to Western interests will certainly prove positive for many, which does provide some offset for EM in aggregate. Valuations are also on their side. So, I would suggest that when you think about the longer term prospects for EM and you're thinking about valuation or the recent performance, a lot of the underperformance recently has actually not come from valuations, however, it's come from weaker fundamentals. And so those weak fundamentals combined with some of the more, I guess, burdensome aspects of things like food and energy inflation, which make up a much larger portion of the CPI basket in those areas, and therefore are more stressful on consumer spending, we are actually significantly underweight EM on that shorter term tactical horizon. So while we do foresee some challenges in the US as it relates to the trajectory of the economy and so forth, we do significantly prefer the US to the rest of the world on a tactical basis, just given the unfolding landscape that we see.
Let's turn to real assets, and I'm thinking specifically about natural resources, global real estate, global infrastructure. How effectively will they hedge the risk of inflation, and how will they provide that inflation protection?
When we talk about real assets like natural resources, real estate infrastructure, as you mentioned, we're investing in those areas through the public equities of the companies in those areas, not in the underlying commodities or assets. So as a result, you do have market exposure when investing in real assets in this way, but they do provide still some nice diversification benefits as well as hedges, as you mentioned. And on that inflation front, investing in natural resources is actually a very effective hedge against unexpected inflation. We were overweight the asset class in the first half of this year, and it worked very well as commodity prices rose, which, as you know, had contributed significantly to the inflation that we had seen. Infrastructure also benefits to an extent in an environment like that as well. But when you think about both infrastructure and real estate, they do have some additional attractive attributes during periods of high volatility as well as downward biased markets because each carry higher than market dividend yields. They have more stable cash flows, which are certainly appreciated during periods of volatility like we've seen and frankly are probably likely to continue to experience at least over the near to intermediate term.
What's your expectation for inflation and interest rates here in the US for the rest of this year and beyond into next year? And I'll ask the same question about Europe.
We think that what the market is pricing into inflation break evens over the next year looks pretty optimistic in terms of how much inflation will actually come down. So, 1 year break even suggests the market is looking for 1.8% headline inflation a year out. And while we know that headline could be lower than core inflation as commodities could actually suppress the headline inflation numbers a year out, it still looks optimistic to us. What's worrisome in the most recent inflation print was the acceleration in services inflation, which led core inflation to actually tick higher for the month. And that's a problem for the Fed because it's less tied to what's happening in the context of commodities or even supply chains, but instead likely ties back more closely to what's going on in the labor market. And getting wages under control may necessitate more economic damage to accomplish than what was previously being assumed by the market. Now, to be clear, we do expect inflation will come down. There's plenty of evidence to suggest that it will. It's the pace of that decline, and frankly, the Fed's comfort with the pace that will prove out in the context of what this means for the economy and investors. Now, in terms of how that translates into interest rates, Fed funds futures has the Fed moving another 150 basis points or so by March of next year, taking short rates to say 4.5 to 4.75. With what we know today, that sounds about right as a plateau, assuming that inflation does start to show some substantive moderation between now and then. What is less clear, I guess, is how long rates will need to react in the context of what that means for the Fed's projections on inflation and how much does the economy actually need to slow in order to get there. So we'll be watching the long end of the curve with the 10-year now at threatening 4%. And if economic concerns increase as the monetary tightening does its job in cooling the economy, you could see investors seek the protection of bonds, which would actually pull down rates at the long end.
So, given the fact that you think the market is underestimating the power of inflation, what is your take on tips versus nominal bonds? Uh, would you allocate much to tips at this point?
Well, with the fact that you have a situation where the inflation expectations from the market's perspective look a little bit low, you may not be getting paid fully in the tips markets. So, we have a neutral allocation there. I think that again, when you look at the break even trajectory, it does suggest that perhaps most of the good news is already in that market. So, from our perspective, you wouldn't necessarily need to increase your allocation there. So that's the bias that we've been taking.
So, I want to ask one more question about the capital market assumption report. It paints a picture of global growth slowing to about 2.6% annually. Is there anything that you think could lead to a surprise on the upside?
Well, it certainly feels like I've talked a lot about the headwinds from higher inflation, higher rates, deglobalization, et cetera. So certainly a fair question. We tend to think about things relative to expectations, of course, or directional trends, et cetera. And on that basis, caution certainly seems warranted. But on an absolute basis, it's really hard to argue that things economically are really that bad if we do get inflation under control. As you know, the consumer is still spending. The banks and the card networks are pointing to, I want to say, 11 or so percent growth in consumer spending year over year in recent months, which is still quite strong. Consumer leverage is in very good shape. Corporate leverage is in very good shape. The financial sector is exceedingly well capitalized. So we don't have the kinds of structural imbalances that we saw in more significant economic recession scenarios. If you recall, the move off of the June lows, as short-lived and premature as it may have been, was based on a view that the Fed may be close to the end of its tightening campaign and the economy might actually skirt recession. In another few months, we'll probably be talking about that again, that we are near the end of the tightening cycle. The question will be, how is the economy holding up? But there is still a case to be made for a soft landing. It's by no means out of the question. It's just getting harder as inflation proves to be more durable than hoped. But longer term, again, this too shall pass. Inflation will moderate to levels that allow rates to find a more consistent kind of footing with that slower growth backdrop that we think. And slower growth with contained inflation is really not necessarily a bad backdrop for risk assets. We've lived through that for some time with some pretty healthy results. So there's still plenty of reasons not to be overly negative, despite some of the near term challenges.
So there's one issue that was not covered in your capital market assumption report, but I think it's relevant for us to speak about today. We're speaking on September 27th, and there's been a dramatic decline in the British pound. It now trades at almost parity with the dollar, as does the euro. What is causing this, and what is the significance for U.S. investors?
Dramatic is certainly a good term for what we've seen with the pound, and what's happening there does differ from what we're seeing with the euro. So, with the euro, the decline against the dollar is not inconsistent with what you would expect, just given the relative trajectories with respect to the respective central banks, where the Fed has moved short term rates far more aggressively than the ECB, which has widened the gap in rates, which attracts money into dollars and appreciating the currency. That's a fairly normal course of action. What's happening in the UK, where you have large declines in the currency alongside a rise in yields, suggests a significant lack of confidence in UK assets following this large unfunded tax cut that we've just learned about, which is clearly at odds with what the Bank of England is trying to do in order to actually fight inflation. So We're going to be watching pretty closely for any further clues on the policy and monetary side in the UK, but the currency depreciation at the same time as such a dramatic rise in rates looks more like an emerging market economy than a developed one. So caution would certainly appear warranted until more is understood with respect to that path forward. Now, for US investors, money invested outside the US certainly has struggled in US dollar terms when translated back. We would certainly assume that the majority of the currency moves ought to be behind us, making the waters perhaps a bit safer to enter from that standpoint. But the fundamentals still clearly favor the US, and that's where we're concentrating our positioning right now.
So Great Britain may be in a bind here as an economy, but it would be a great time for Americans to go and visit there. If there's one key takeaway that you would like to leave with our audience of advisors about the way in which Northern Trust Asset Management approaches its capital market forecasts that distinguishes it from its peers, what would that be?
We are certainly fortunate to have a lot of investment talent across our asset and wealth management businesses, which includes top down strategists, bottoms up analysts, asset class experts, et cetera, as well as the ability to tap into additional subject matter experts from outside the firm. We go through this process using a phrase we refer to as forward looking but historically aware. And we make these forward looking projections on growth, inflation, monetary policy, the things we've talked about, but being mindful of what history tells us about each of these as anchors, if you will. But what's particularly unique, in my view, is just the role that these strategic themes play, the six that we talked about at the outset, that really set a framework for how to think about the unfolding bigger picture trends and how that will influence asset class returns over time. A lot of good work goes into those strategic themes and their investment implications, and I think does represent a differentiator for our process.
Well, we will include a link to the Northern Trust Asset Management Capital Market Assumption Report in the notes that accompany this podcast. You'll be able to learn more about what Chris and his team project for the next year and beyond. Chris, is there anything else you'd like to add?
Bob, I just want to thank you and Advisor Perspectives for having me on the podcast and look forward to having a chance to join you again in the future.
It's my pleasure. You're quite welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Chris Shipley of Northern Trust Asset Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.